Stop. Before you make a move that could cost you a fortune, I need you to sit down and watch this entire video, because what I'm about to share with you could be the most important financial decision you make this year. And I'm not saying that to be dramatic. I'm saying it because the pattern unfolding in the silver market right now is one that most people have only read about in history books, and the ones who didn't recognize it when it was happening lost everything. If you're sitting there watching silver pull back from its recent highs and thinking, maybe I should take some profits, or maybe I should get out while I still can, I understand. That instinct makes complete sense on the surface. When something runs up dramatically and then starts to wobble, every rational part of your brain screams, lock it in. But that instinct, in this specific moment, with this specific asset, could be the most expensive mistake of your financial life. And I can prove it to you. Here's what we're going to cover today. We're going to look at what's actually driving silver's price movement and why a short-term pullback means nothing in the context of where this is heading. We're going to dig into the physical supply situation, and I promise you, when you see these numbers, you will not want to sell a single ounce. We're going to walk through the industrial demand story that is just getting started and that virtually nobody is talking about in a way that connects all the dots. We're going to look at what happened to the people who sold silver during the last great squeeze in history. And we're going to examine the paper versus physical dynamic at the major exchanges that could ignite a move that makes everything we've seen so far look like a warm-up act. But before I get into all of that, if you've been watching this channel for a while, or if you're new here, there's a free guide in the description below that has been genuinely changing lives. It breaks down the exact strategies that thousands of American retirees are using right now to shield their hard-earned savings from what's happening in the broader financial system. It covers everything from how to hold physical silver and gold the right way to the legal account structures that most people have never heard of. Grab it. It's completely free and it's sitting right there in the description. Check it out now or at the end of the video, but don't forget to grab it. Now, let's talk about why you absolutely cannot sell your silver right now. Let me start by telling you about a man named Harold. Harold doesn't exist as a single person. He's a composite of dozens of conversations I've had and thousands of situations I've studied. Harold bought silver a few years ago when the narrative was becoming clear. Inflation was becoming a problem, geopolitical tensions were escalating, and the purchasing power of the dollar was being quietly destroyed by years of debt accumulation and money printing. Harold was smart. He did his research. He bought his silver. And then, when silver started running hard, when he started seeing significant gains on his investment, Harold got scared. Because Harold had been conditioned by a lifetime of stock market thinking, where the wise move is to take profits and not get greedy. Harold sold half his position. And then silver kept going, and Harold's regret became a permanent, nagging thing. You don't want to be Harold. And once you understand what's actually driving this market right now, you won't be. The first thing you need to understand about silver is that it is not like any other asset you own. Gold gets all the headlines, Bitcoin gets the excitement, but silver sits at this extraordinary intersection of monetary metal and industrial necessity that creates a supply-demand dynamic unlike anything else in the investment universe. Silver is simultaneously a hedge against financial chaos and a raw material that the entire modern economy runs on. And right now, both of those functions are firing at the same time in ways they never have before. Let's talk about the deficit. For 6 consecutive years, 6 years in a row, the global silver market has consumed more silver than has been mined and recycled. Think about what that means for a moment. Every single year, the gap between how much silver the world needs and how much silver the world produces has been met by draining existing stockpiles, and those stockpiles are not infinite. When the Silver Institute, which is the authoritative research body that tracks global silver supply and demand, publishes data showing that the world is running at a structural deficit exceeding tens of millions of ounces annually, and that this is the 6th year in a row of that reality, you have to ask yourself a very basic question. What happens when the stockpiles run out? The answer is a price discovery event that financial historians will write about for generations. Now, here's where it gets interesting, and where the story that most people are telling gets incomplete. When people talk about industrial silver demand, they typically mention solar panels and electric vehicles, and they move on. But that barely scratches the surface. Yes, the solar industry has become one of the largest consumers of silver on the planet. Every single photovoltaic panel requires silver for its conductive paste. And as countries around the world race to meet climate targets and energy independence goals, solar installation isn't just growing, it's compounding. The projections for global solar capacity additions over the coming decade would require silver volumes that simply do not exist in above ground accessible stockpiles at current production rates. But let's go deeper. Because while everyone is talking about solar panels, something else is quietly consuming silver at a staggering rate, and almost nobody is connecting this to the silver price story yet: artificial intelligence infrastructure. Every AI data center that gets built requires enormous quantities of silver for its circuit boards, connectors, and thermal management systems. The AI build-out that began accelerating over the past few years represents one of the most silver-intensive technological revolutions in human history, and it's not slowing down, it's accelerating. We are in the early innings of a permanent structural shift in how the global economy processes information, and silver is woven into every layer of that infrastructure. Add to that the electrification of industrial processes, the growth of 5G networks, which use silver in their antenna systems, and the expansion of medical and pharmaceutical applications, and you have a demand picture that would make any commodity analyst lose sleep. Now, the supply side. Where does silver come from? The majority of global silver production is not from dedicated silver mines. About 70% of all mined silver in the world comes as a byproduct of mining for other metals: copper, zinc, lead, and gold primarily. This creates a fascinating and underappreciated supply constraint. When you mine for copper, you don't ramp up copper production to get more silver. You ramp up copper production to meet copper demand. The silver comes along for the ride. This means that silver supply growth is essentially constrained by the capital investment decisions of base metal miners, who are not making those decisions based on silver demand. They're making them based on copper demand, zinc demand, economic cycles, environmental regulations, permitting timelines, 1,000 different variables that have nothing to do with how much silver the world needs. And opening a new mine, when it does happen, takes anywhere from 7 to 15 years from discovery to production. The silver that the world needs 3 years from now is not in the ground waiting to be extracted. It doesn't exist yet. Here's a story about what this kind of supply squeeze actually looks like in practice, and what it can do to people who are on the wrong side of it. In the late 1970s, two Texas oil billionaires named Nelson and William Hunt had a theory. They believed that silver was massively undervalued, and that the paper dollar was headed for serious trouble. They were right about both, so they started buying silver, physical silver. Not contracts, not ETFs, actual deliverable silver. They accumulated somewhere in the neighborhood of 200 million ounces, roughly a third of the world's non-government silver supply at the time. And as they bought, the price climbed and climbed and climbed. People who had bought silver at low prices and held it saw their wealth multiply many times over. And then what happened? The exchange changed the rules. COMEX, the commodity exchange, introduced something called Silver Rule 7, which dramatically restricted the ability to buy new silver contracts and essentially forced leveraged speculators to close their positions by selling. The Hunts were eventually squeezed out. Silver crashed. Now, here's the lesson that almost nobody draws from that story. The Hunts ultimately lost their silver position, but the people who owned physical silver outright, with no leverage, no margin, no paper contracts, they participated in an extraordinary price run and survived the crash far better than the leveraged players. The Hunt brothers story is cautionary for leveraged speculators. For physical holders, it's actually a story about what happens when a real supply squeeze meets unprecedented buying pressure. And the conditions today are far more structurally sound than anything the Hunt brothers manufactured, because this time the demand is not speculative, it's industrial. It's baked into the physical infrastructure of the modern world. You cannot unbuild the solar panels. You cannot unwire the data centers. You cannot uninstall the EV charging infrastructure. The demand is real and it is growing. Let me talk to you now about something that very few retail investors ever actually look at, but that institutional money watches obsessively: the paper to physical ratio at the COMEX exchange. What this means in plain language is this: for every ounce of physical silver that is actually held in the COMEX vaults and available for delivery, there are many multiples of that amount in paper contracts, promises to deliver silver that theoretically represent ownership of silver that does not physically exist. This ratio has historically been a flashpoint. When enough large buyers decide to take physical delivery of their contracts to actually demand the metal, rather than simply rolling their positions over as paper promises, the exchange faces a delivery problem. And delivery problems in commodity markets have historically produced some of the most violent price moves ever recorded. The monitoring of COMEX registered vault levels, the silver that's actually there and available to be delivered, is a practice that every serious silver watcher engages in. And what those inventories have been doing recently has gotten the attention of a lot of very serious people. Now, let me bring the gold to silver ratio into this conversation, because this single metric is one of the most powerful tools for evaluating whether silver is undervalued or overvalued relative to its monetary cousin. Historically, over thousands of years, going back to the Roman Empire, the medieval period, the early industrial era, the gold to silver ratio has typically ranged between 15 to 1 and 50 to 1. That's the ratio of how many ounces of silver it takes to buy 1 ounce of gold. Today, even with silver's significant appreciation, that ratio remains elevated relative to its historical norms, which means that even after everything silver has done, even after the extraordinary run we've seen, silver is arguably still undervalued relative to gold when you apply the historical framework. When that ratio compresses back toward its historical average, as it has done in every major silver bull market in history, the gains for silver holders are dramatic. We saw it in 1980. We saw it in 2011. We saw it in 2020. Each time the ratio was elevated and then compressed, silver outperformed gold by a wide margin. And speaking of monetary metals, here is something that is happening at the institutional level that should give every silver holder tremendous conviction. Central banks around the world have been accumulating gold at the fastest pace in recorded history. The narrative around the dollar's role as the global reserve currency, the so-called de-dollarization trend, is not some fringe theory anymore. It's the stated policy direction of multiple major economies. Countries that once held their foreign reserves primarily in dollars and dollar-denominated assets are diversifying. They're buying gold. The BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing list of new members, represent a combined economic weight that rivals the Western world, and they are systematically constructing an alternative financial architecture that does not depend on the dollar. What does that have to do with silver? Everything. Because historically, when gold moves in a sustained, macro-driven bull market, not a speculative spike, but a real fundamental repricing of hard assets relative to fiat currency, silver follows, and then silver runs harder than gold, because silver carries the monetary premium of gold, plus the industrial scarcity premium. Both engines fire at the same time. And this is exactly the moment where I want to speak directly to those of you who have been watching your retirement accounts and wondering what happens next. I get a lot of messages from people who are in their 50s and 60s, who have spent decades building their nest egg, working hard, saving, doing everything right, and who now look at the financial landscape and feel genuinely uncertain. The stock market at these valuations, with corporate debt levels where they are, with interest rates having done what they've done to the bond market, with geopolitical uncertainty at levels not seen in decades, the traditional 60-40 retirement portfolio is being stress tested in ways that most financial advisors have no framework for. If that sounds familiar to you, I want you to know about something we've put together. A gold IRA isn't just for gold. You can hold silver in it too. Physical silver. Real metal, held in a federally approved depository inside a tax-advantaged account. For Americans who have at least $100,000 in any retirement account, a 401k, an IRA, a pension rollover, this is a conversation worth having. There's a free resource in the description that walks through exactly how this works, how to do it without triggering tax penalties, and what to look for when choosing a custodian. Whether or not you end up doing it, the education is valuable. Go check it out. And now, let's talk about what the next phase of this looks like. Here's a thought experiment I want you to sit with. Imagine you are the chief investment officer of a major sovereign wealth fund. Let's say you're managing the reserves of a mid-sized country that has traditionally held most of its foreign assets in U.S. treasuries. Your government is watching the debt-to-GDP ratio of the United States grow at a pace that would be alarming in any corporate context. You're watching the geopolitical fractures deepen. You're watching trade wars reshape supply chains in ways that take decades to stabilize. And you have a mandate to preserve the purchasing power of your nation's wealth across generations. What do you buy? You buy things that cannot be printed, things with finite supply, things that have preserved value across civilizations and centuries. Gold first, then silver. And if even a fraction of the institutional capital that is currently allocated to sovereign bonds begins to rotate into physical precious metals, the demand pressure on a market as small as silver will be extraordinary. There's also a demographic story here that rarely gets told. The generation that is entering retirement right now is the largest in American history. They are inheriting wealth from their parents in what analysts are calling the greatest intergenerational transfer of wealth in human history, trillions of dollars moving from one generation to the next over the coming years. A significant portion of that wealth is looking for a home. Some of it will go into equities, some into real estate. But a growing subset of that wealth, particularly among people who have lived through recessions, watched their parents lose value in 2000 and 2008, and who have developed a healthy skepticism of paper promises, is going into hard assets, into physical silver, into physical gold, into things you can hold in your hand, things that have no counterparty risk, things that have never, not once in 5,000 years of human civilization, gone to zero. Let me give you one more piece of the puzzle before I bring this all together. The recycling story. As silver prices rise, recycling becomes more economically viable. More silver gets recovered from electronics, from industrial scrap, from photography films that still exist in old stockpiles. And the silver bulls will correctly point out that this adds to supply and provides some pressure relief. This is true, but here is also true. The rate at which silver is being consumed in applications where recycling is essentially impossible, solar panels buried under concrete housing, automotive catalysts burned off during combustion, small electronics that end up in landfills across the developing world, is enormous. The Silver Institute estimates that a substantial percentage of global silver demand goes into applications where the silver is consumed and cannot be economically recovered. It's gone. It becomes part of the physical world in a form that cannot return to the market. When you consume a commodity in ways that destroy it permanently, and you are simultaneously in a multi-year structural deficit, and your industrial demand is tied to technologies that are at the beginning of multi-decade growth curves, and your monetary demand is rising because of macro forces outside anyone's control, that is a setup. That is the kind of setup that, when it finally resolves itself in price, happens fast and leaves people who sold too early standing on the platform watching the train pull away. Think about what happened in 2008 for a moment. Not just the financial crisis itself, but what happened to silver in the year that followed. In the initial shock of the financial crisis, silver sold off hard, just like it's selling off in shorter-term windows today when people get nervous. Every time there's a macro shock, there's a flush. Weaker hands get shaken out. People who don't understand the long game sell to people who do. And then, and this is the part that the sellers never talk about, silver came roaring back with a vengeance, eventually running all the way from single digits to nearly $50 an ounce in the bull market that followed. The people who sold in the panic of 2008, who looked at the short-term price action and said, "I need to get out," they watched in regret as silver nearly quintupled from their exit point. Are you certain that the people selling silver today aren't making exactly the same mistake? Here's the fundamental truth about where we are right now. A short-term pullback in a secular bull market is not a reason to sell. It is, if you have any conviction in the underlying thesis, an opportunity to buy more. Every great commodity bull market in history has had violent corrections along the way. Corrections that shook out weak hands, that generated headlines about the bull market being over, that caused panic sells, and then continued higher. The silver thesis is not about what happens this week or this month. It's about what happens when 6 consecutive years of structural supply deficits meet rising industrial demand, meets a monetary system that is being stress tested at its foundations. That resolution does not happen overnight. It builds. And the people who understand what they own and why they own it, the people who have the patience to hold through the noise, are the ones who end up with generational wealth outcomes. So let me leave you with this. If you own silver right now and you're thinking about selling, ask yourself one question. Has anything changed about the underlying supply-demand reality? Has the silver deficit been resolved? Has solar installations slowed? Have AI data centers stopped being built? Has de-dollarization reversed? Have central banks started selling gold? If none of those things have changed, and they haven't, then what you're reacting to is noise. You're reacting to short-term price action in a long-term story. And selling a long-term story because of short-term noise is exactly the kind of decision that wealthy investors never make, and that everyone else makes constantly. The market is going to test your conviction. That's what markets do. The institutions that accumulate silver at scale, the ones who buy when everyone else is scared, they are counting on your fear. They need you to sell because your selling is how they buy. The moment you sell your silver to someone who understands this story better than you do, you have permanently transferred your wealth to them. Don't do that. Hold your position. Understand what you own. And if anything, use periods of weakness to add to your holdings, if you can afford to do so without overextending yourself. For those of you who have been watching until the very end, I have something special for you. The free guide in the description is the starting point. But if you're an American retiree with at least $100,000 in any retirement account, and you want to understand exactly how to position your retirement savings to weather what's coming, the real macro story, the practical steps, the specific vehicles, mention that you watched this video when you reach out through the link in the description, and you'll qualify for a complimentary, exclusive, one-on-one educational web conference. No sales pressure, no obligation, just a real conversation with someone who can walk you through the specifics of your situation. That offer is only available to people who watch to the end, only to American retirees with at least $100,000 in a qualifying account, and only while availability lasts. Do not wait on this. The macro clock is not waiting for anyone. The silver you're holding right now, it's a piece of something very big. Don't let short-term noise shake you out of a long-term position. The next chapter of this story hasn't been written yet, and if the historical parallels are any guide, it's going to be one that people talk about for a very long time.